Welcome. This is Scott Brooks. To today's presentation, I've titled The Definitive Guide to Fixed Annuities, Safe Solutions for Today's Low Interest Rate World. Welcome to today's presentation. A few disclaimers at the beginning. Just to give everyone a little bit of background about me, I actually graduated from undergrad in December 96 from UT Austin. I actually spent the first year after college working in the dental industry, and then I started working in financial services in 1998 and pretty much have worked in financial services since then. I actually ran the Edward Jones office in Carlsbad, California in 1998 and early to mid 1999. I actually wanted to move back to Texas where I was from and ended up getting a job for Bank United Securities. A friend of mine from college actually was working there, and so I moved from San Diego to Dallas, actually, where I worked in Plano, Texas, during 1999 and 2000 with the security side of the bank, selling annuities. From very late 2000 through 2005, I actually worked for Fidelity Investments in the DFW area in the Dallas market. While at Fidelity, I completed an MBA program in 2004 and also the CFP program in 2005. In 2006, I actually worked. My plan, actually, once I was in Dallas, was to move back to Houston and open my own financial planning practice. But my dad unfortunately passed away, and I ended up having to close down his law practice for 6 to 9 months. He still had a pretty busy practice, so I had to do that for a little while. Anyway, I decided to take a job for a little while. I wasn't really ready to do that, so I worked with Comerica Securities for a year. My heart was really always on being an entrepreneur, so I designed some training that I sold from 2007 through 2010 that was called Rollover Coach, which was designed to help financial advisors and insurance agents increase their knowledge on the 401k rollover marketplace, since that's pretty much the only thing I did when I worked at Fidelity for 5 years. From there, I started actually Annuity Resources in late 2010, actually. So from 2010 through 2020, we actually existed as a referral organization. So we did a lot of marketing and advertising. We basically connected consumers that were interested in annuity information with financial advisors and insurance agencies. That was kind of the first half of what we did. And then I decided actually this year that we decided to set up an agency and actually sell directly some of the annuity, so basically fixed annuities and also income annuities, so SPIAs and DIAs. So what I decided to do, we would sell those internally, and then if consumers were interested in index annuities, variable annuities, fee-based investment management, or legacy planning, we would actually connect them with different partners of ours around the country. So, some of my hobbies, I was a tennis player for a long time until I hurt my knee and actually got up to USTA 4.5. I love to travel. I've been to 33 countries, I believe, at this point. So why don't we get into it? So one of the problems that today savers have is obviously interest rates I've read some articles saying that interest rates are at 5,000-year lows. In fact, in recorded history, it's really hard to find a point in time where interest rates are actually this low. And the flip side of that is that stock and bond markets are at record highs. So what do you do? If you're looking for safety, if you're looking for income, what exactly do you do, right? Especially since if interest rates went up quite a bit, obviously the stock and bond market probably would both have pretty significant losses. Bonds have what's called interest rate risk. As rates go down, the bond values go up, and if rates go up, bond values actually go down. So the question is, what do you do for safety and security? We also have we also have inflation, the things that we need to live on, right? The last year especially, we've seen a lot of food inflation. Just the housing keeps going up. There's been inflation in the things that we actually need to live on, the basic essentials, right? So what do you basically do? Where do you go for safety? I wanted to start off and just show the difference in what kind of earnings growth would be over time. I took $100,000, and across the top row, you'll see the impact of different interest rates, right? And what they would do to your earnings, right? And over time, right? So you can see, you start off at 0.3%, through 5 years, that 100,000 would grow to $101,509, right? Now, if you earned, instead of 0.3, right? If you earned 2.45, that 100,000 would actually grow to 112,865. So this is a really nice grid. You could actually kind of stop the presentation and take a look, and you can think about, okay, for the money that you have at the bank or wherever that you're earning, if you have a safer return, right? You could take a look and see, you could take a look and identify what interest rate roughly you're earning. And then you can also see, if I was able to earn 2 or 3%, how much more income and interest would that generate for me, not only initially, but also over time. So this is obviously one way to look at it. Another way to look at it is to take a look at that same $100,000 and say, okay, how much monthly income will this create if you are earning this return, right? And I split it down. There's one row that has monthly income and one row that has yearly income. Now that $100,000, at 0.3% would only produce $25 a month in income. For the year, $300 in income. Again, if you're able to earn, instead of 0.3, 2% interest, it went from $25 a month to $167 a month almost. And instead of $300 a year, up to $2,000 a year. Reason I wanted to show these graphs is that right now in the United States, a lot of money is in the banking system that's earning 0 to 0.3%. And if you look at the FDIC data, the average bank is really not paying much interest at all. It's virtually nothing, right? So the question is, what do you do to find for a safe return to keep your money safe, but also still generate a little bit better interest? If you take a look at, a pyramid, right? What types of investments, what can you do with your money that would be actually the safest places to invest? Bank CDs would obviously be one, right? They're FDIC insured. Savings accounts, money market accounts, U.S. Treasuries, right? Some of the U.S. Treasury is just a way for you loaning money to the U.S. government directly, right? And then fixed annuities would be what I would put them into one of the 4 safest ways to invest. I personally believe that fixed annuities are actually safer than most bonds because the odds of a specific company going bankrupt is, depending on the company, is probably higher than an insurance company going bankrupt, just all things being equal. But regardless, fixed annuities will be considered by many people throughout the industry as one of the 4 safest places that you can actually invest and actually put money. There also is a difference between, when I mention the word fixed annuity, I also consider fixed annuities to be what I call MYGAs, multiple year guarantee annuities. This basically just means that the interest rate that you're earning is locked in for the term of the contract, and it's known when you actually invest. This is different from some of the traditional fixed annuities that have renewal rates where you might only know what you're earning for a period of time, right? And then the company can pay you whatever they want to. So, again, what is a fixed annuity? A fixed annuity is a contract with an insurance company that guarantees the insurance company will pay the buyer a guaranteed fixed interest rate on their contribution for a period of time. So it's basically just a contract with an insurance company that you will earn a guaranteed fixed interest rate on the amount of money that you contribute for a period of time. I mentioned on the last slide, there is a difference between traditional fixed annuities and then MYGAs. The main difference being, traditional fixed annuities that were mainly sold in the 1990s, right? If you go back 10, 20 years, they were more commonly sold. What would happen would be you would commit to like a 5-year fixed annuity with an insurance company, And what they would do is they would only lock in and guarantee your rate maybe for 1 or 2 years, and then year 3, 4, and 5 they would pay you what's called a renewal rate. But you didn't know what that was when you actually purchased the traditional fixed annuity. With the MYGA, the interest rate is actually locked in for the entire term, typically. And we here at Annuity Resources, we only sell MYGAs because I want to limit it personally. We want to limit the amount of surprises that our customers have. We want to offer guaranteed products and to where there's not renewal rates. You'll never receive a surprise later in the process, mainly because the rates are fully guaranteed and known before you buy the products. And roughly 90% of the fixed annuities sold today are MYGAs. They're not traditional fixed annuities. What you'll typically find is that a lot of the companies that sell the traditional fixed annuities, a lot of the insurance companies, they mainly have a captive insurance agents that sell typically only their product for the most part. Which is a little bit different. We're an independent firm and we sell over 40. But there are companies out there you go to that sell fixed annuities they really focus heavily on selling only their one company's annuity, which I personally don't think is a good idea. What we won't discuss today is we're not going to discuss index annuities. We're not going to discuss variable annuities. A lot of times annuities can be very confusing when a lot of people that dislike annuities, or a lot of the negative articles you're going to find about annuities typically are either about index annuities or variable annuities. And specifically, it's about the complexity of index annuities and the high fees of variable annuities. We're not going to talk about any of these today. We're also not going to talk about traditional fixed annuities. When I worked at Bank United Securities in 1999, I'll never forget, I had, at that time, I was, in my early to mid 20s, and I had a retired woman actually walked in my office furious, and she had purchased from someone that had been in my office a few years before. So 3 years before I arrived, she had actually purchased a traditional fixed annuity, and they had paid her a really nice big bonus rate at the beginning, right? And what happened was the renewal rate at that time, CDs were paying, I think, around 5 or 6% at that time. So at a time at which CDs were paying 6%, the company actually renewed her at like 2%, and she was furious. She was yelling, screaming. She was super unhappy, right? So this is just that story is one example of why we don't sell them. We don't recommend them on our platform, just because, ultimately this is how the industry has changed over the years, and most of the business today is done within MYGAs, within the industry. So we're not going to discuss those. SPIAs, DIAs, and MYGAs typically, just so everyone knows, typically have the most positive press out of the different types of annuities that you'll look into. And these are the only ones that we sell internally. What happens is when consumers are interested in, if those of you are interested in index annuities or variable annuities, other types of annuities that we don't sell, we have a network of insurance agencies and financial advisors that we work with around the country, that we would put you in touch with. But if you're interested in, the MYGAs and the fixed annuities that we do work with, we would basically work with you directly on that. So the question is a fixed annuity right for you? Well, a few things to think about is, number one, would you like to earn a guaranteed interest rate? Would you like to know what you're earning, to where it's simple, it's easy to understand, and it's a guaranteed return with no surprises? Second thing would be, a fixed annuity might be right for you if you don't want to lose any money. And, I've having been an investor myself for 20 something years, right? It's been even though the last probably 5 to 8 years have been easier. I still vividly remember 2000, 2008, and many people investing today probably don't even have much of a memory of that time. But I understand why you would not want to lose any money. I myself invest my own money very conservatively because I don't want to lose. a bunch of money. So I mean, I understand. So, but if you're that type of person where you don't want to see your statements go down, you don't want to lose a penny, you don't want to lose any money, you want a guaranteed return that's known, that's locked in, then a fixed annuity might be right for you. Also, do you not want to pay any fees, right? So the fixed annuities we're talking about do not actually have any fees. There aren't any annual fees. There are typically not any fees to be when you set up the accounts. There basically are no fees at all. So you don't need to worry about that. Now, also, a fixed annuity would only be right for you if you really did need the money for at a minimum 2 or 3 years. There are, the fixed annuities, the withdrawal options that are available do vary from one company, one product to another, but they only will be a fixed annuity is only right for you that if you can really invest the money for the term of the contract and really you don't need to get to it, or if you do need to get to it, you don't need to access very much of the money. So, but you definitely don't want to be putting money into the products that you might need to spend for the time period that you're actually committing the money for, right? So, and on the shortest end, the shortest term products typically right now are 2 or 3 years. They'll go out. We only work with 2 to 10 year products, but there are products going up to 15 plus years. But I in good conscience, I can't actually recommend someone buy a 15 to 20 year product. That just, to me, that's too long. And also, the last thing, a fixed annuity might be right for you if you like the idea of deferring paying taxes on any gains that it's generated. So if you own a taxable bond, if you own a CD, right, you're actually having to pay taxes on any gains that are being generated, unless it's in a tax-free bond, if every year, right? So as you earn interest, you're having to pay taxes on it. With a fixed annuity, what a lot of people like is that the money is growing tax deferred, right? So if you have the money there invested for 5, 10, 15 years, it's called triple compounding of interest. You're able to grow your money a little bit faster, mainly because you're earning interest on your principal, interest on your interest. You're also earning interest on the money that normally would be lost to taxes every year. So because of that triple compounding, you do grow your money faster over time than you would if you just left it in the bank the entire time. So that's one of the other benefits, is that you're able to, I've had, I remember, I've had families, they really liked, even if the rate was the same, right? If the rate is similar to CDs, right? If it's the same, but yet you have one tax deferred option, right? You're able to, possibly defer those gains for 5 or 10 years. So if that's of interest to you, then that would be another reason the fixed annuity would be right for you. Some of the benefits that you have: number one, the rates are contractually guaranteed. Annuities are contracts between you and the insurance company. With a fixed annuity, a MIGA, the rate is contractually guaranteed in the contract, and you know what it is before you buy the product. So it's contractually guaranteed. Another benefit is, recently the rates have been significantly higher than CDs and savings accounts. But this varies. You'll go through periods of time where sometimes the bank products are more competitive, sometimes annuities are more competitive, fixed annuities are more competitive. You really need to do your research and find out what is the best option for you at that time, right? But in general, the fixed annuities for the same time period will pay higher rates than banks will, all things being equal. Fixed annuity. Another benefit of fixed annuities, they're predictable and they're very easy to understand, right? You don't need to spend 20 hours meeting with 10 people. You're going to earn a fixed return. You're going to know what that is. There won't be any surprises later. It's predictable. You know what you're going to earn. There are no surprises. And they're also easy to understand, right? There are a lot of the other types of annuities, specifically index annuities or variable annuities. There are a lot more moving parts, and also they're much more difficult to understand than a traditional fixed annuity would be. So this is another benefit. Your principal is 100% guaranteed by the insurance company. So the insurance company will guarantee that you will receive your money back, right? up to their claims paying ability. Also, in some states, specifically Texas and Florida, Texas where I live, and Florida, annuities have great creditor protection. So, a lot of times people that are self-employed, a lot of times people that like to buy annuities will be higher income individuals. People that are self-employed, they have a business, doctors, anyone that's in a profession that has a higher likelihood of getting sued, right? There's a famous story about O.J. Simpson, and even some of the Enron executives from years ago had a lot of their money in annuities and therefore was untouchable, right? So, having the money creditor protected, a lot of business owners, especially physicians, or, if you might get sued, then having that creditor protection can give you another added peace of mind, right? There's no upfront, no annual fees. It's 100% liquid at maturity. So one of the things that's interesting is that a lot of times I believe consumers get very confused about the different types of annuities. Just from reviews that I've seen online, people will assume that the insurance company, for example, the insurance company is going to keep your money, right? That's actually not true when it comes to fixed annuities. They're 100% liquid when they mature. And literally you can either let your annuity renew again with that insurance company, and when it matures, you'll be notified. You'll have the option of leaving your money there. You could also transfer that annuity to another company, right? You could transfer it to another insurance company, or you could just say, you know what, send me a check. You could pay taxes on the gains at that time, and that's it, and just pull your money out. So you have that 100% liquidity at maturity for the term. And a lot of people like that. They like the fact that you can actually annuitize the contract. That is another option that you have with the annuity at that point, but that's just one of the options. But if you don't want to do that, right, you're fully able to, you could take that money when it matures and go buy a bank CD. You could go put it in your checking account. You could do something else with it, right? So this is another benefit. Now, also fixed annuities have some of the lowest commissions out there among the categories, specifically MYGAs, short-term products. Most insurance agents aren't going to get too fired up to sell you a 2-year MYGA. It's probably going to not pay them very much, right? So that's another part of it, is that a lot of times when you deal with people within the financial services industry, the commissions are generally the highest to insurance agents on index annuities and variable annuities. And that's just the reality. That's the truth, right? And but with these fixed annuities I'm talking about that we sell on our platform, they actually have the lowest commissions. We also reveal what the commission will be on our website as well. Fixed annuities can also be used with bonds and CDs and a ladder. So we'll talk about a ladder in another slide, but you can combine both fixed annuities with CDs, for example, to look and to see which rates are the best. And maybe you do a 4-year ladder where you buy a 2-year product, a 3-year product, and a 4-year product. You could use the CD for the 2-year product, and then the fixed annuity for the 3 and 4 year, for example. We'll talk a little bit more about that later. But also you can use both retirement dollars inside of an IRA and also taxable accounts when you're actually setting up your annuity. So you could use money that's in your checking account, savings account, that's taxable, that you just have laying around, that you have at a bank or somewhere, or you might also bank or brokerage firm, wherever the money is sitting, or you could actually use an IRA that you have to purchase the annuity as well. So if you have an IRA, or you could actually also do a rollover of a previous plan into one of these. You could do a rollover, if you're eligible to, into an IRA, into one of the products as well. So they're flexible in terms of, there are different ways that you could actually use different types of accounts to purchase these fixed annuities in, if that makes sense. So now, what are some of the things you want to be aware of? One is there's a surrender schedule for every annuity. In our website, when you click on the detail for each product, it'll actually show you what the surrender schedule is. So you'll know in advance exactly what the fee would be if you actually have to take out money early. So there are sometimes surrender charges. Some of the contracts allow you to take out a certain percentage, maybe your interest or maybe 10% per year. But but also there are other companies that don't allow any withdrawals, right? So if you take out any money, then you would actually have a surrender charge, right? So you really want to know, if you might need to use the money, you definitely need to look for products where they're more flexible withdrawal options, just so you have a little bit more access than other products, right? Normally, the less ability you have to withdraw money, the higher your rate is going to be. That makes sense. So the insurance companies will reward you if you don't need the money for 3 or 4 years. Then they will a lot of times reward you and pay you a higher rate than if you had to have access to take out some of the money per year, right? Then they would pay you a little bit lower rate, right? But knowing the surrender charges and the penalties, that's the first thing you want to know for the product. Another thing would be the possible market value adjustment for early withdrawal. So a market value adjustment is really just another form of a penalty. And the reason why these market value adjustments exist is that the insurance company, let's say you buy a 5, 6, 7 year fixed annuity, right? And what they're doing is they're going and they're actually committing their money. They're typically buying 5, 6, 7 year products. They could be buying bonds. They could be investing in other instruments. They're typically not for 1 or 2 years, but they're for 5 or 10 years. Right? So the market value adjustment basically, and not all of the fixed annuities actually have market value adjustments. Again, our website will actually reveal whether the product does have a market value adjustment or not, but it's basically a penalty or a credit that's assessed if you take an early withdrawal. Now, if interest rates continue to go down, then you could actually have a credit when you actually take out money, right? So you could actually get a credit. The problem with that is interest rates, like I mentioned earlier in the video, are sometimes at 2,000-3,000 year lows by some people's estimates. So they're very, very low right now. So the odds of having a market value adjustment are very high 2 to 5 years from now, in my opinion. So there's nothing wrong with this. Just know that you don't want to be committing money that you might actually need, because you could actually have to pay both the surrender charge and the market value adjustment. And all the market value adjustment does is help. You're basically sharing the risk with the insurance company. They're going to do their job. They're going to invest and try to earn a higher rate if you commit the money for a longer period of time. But just like with CDs, there's going to be penalties if you get to your money early, right? So that's the second thing to be aware of. And just know that, again, liquidity and how much money you can access varies from one product to another. Our website does allow you to search for products that actually have withdrawal availability. So if you think you might need to get to some of the money in the filter, one of the drop downs is withdrawal options. So if you definitely need withdrawal options, then you would definitely want to apply that filter on the website. Another limitation is the guarantees are only backed by the insurance company's ability to pay you, right? In general, we're going to talk about later about the safety of insurance companies and why they're safe, why they're very safe vehicles in general. But just know that the guarantees are backed up by the claims paying ability of the company. So you also want to consider that. There are state guarantees that are in place, but most insurance agents in general are not actually supposed to use the guarantee as a reason to buy the products. Just know that there is a guarantee. The amount that that's guaranteed for varies based on the state that you're in. And you definitely want to look at the fine print on the state guarantees that you're on your state. So anyway, they are safe in general. We'll talk about the safety more in a little bit. Another thing to be aware of is that some of the fixed annuities will automatically roll over, just like bank CDs, if they mature and you don't do anything. So typically you'll be notified from the insurance company when they're getting closer to maturity, and you'll have 30 days, you'll have a few weeks to decide what to do, right? So you definitely want to monitor. What we do for our clients is we will actually proactively get in touch with them, before, usually a few months before the annuity will mature, and just let them know, just basically just try to help and say, your annuity is coming due. These are the options that you have, right? And then that way you can decide, okay, I want to leave. The insurance companies typically will make an offer to you to keep the money there, right? So you can use our platform to compare the rates at other companies within our network, right? So you could say, okay, well, I want to accept their offer and keep the money, renew it at another 3 years at this rate, or you can actually decide to take your money out and then transfer it to another annuity if they have a better deal, or if your needs change. You can also say, Scott's, we want a check, right? And we can actually, the insurance company can actually help you, can just cut you a check, and you could take the proceeds and do with it whatever you wish, right? So these are some of the things you also want to consider and think about. Another thing I'll mention is, especially if you have a 401k that you have matching contributions that are available, personally, I would consider, before buying a fixed annuity like this, you definitely want to take a look at maxing out your 401k, at least at a bare minimum up to the match. If you're working for a company and they're matching your contributions into your retirement plan, you want to contribute at least up to get that free money before you look at doing anything else, right? So anyway, also any income withdrawals are taxed at ordinary income rates when you actually take the money out, right? So you'll be paying taxes at ordinary income tax rates on the gains of the annuity. Now, why don't we talk a few minutes about laddering? I did mention this earlier in the video. Basically, if you think of a ladder, I have a picture of a ladder up here on the top right. A ladder can help you benefit from rising interest rates. The reality is we don't know what rates are going to do. Especially, it's interesting. I could make a case that rates are going to go up, right? You could also, based on all the money creation in the last few years, you could say, well, interest rates have been at 5,000-year lows, are going to go up. I could also make a case that, hey, you know what? If you take a look at, like in Europe, the more debt the economies have, the lower rates go. And I could also make a case that the rates are going lower, right? Reality is we don't know what's going to happen in the future. One of the things you can do, though, is set up a ladder, which is basically just taking your money and then, buying different maturities, basically, for the terms. And it will help you if rates go up. You're basically you're diversifying the terms to help you if rates go up, or if rates go down, you're locking in some of the higher rates for longer, right? And if rates go up, it also helps you, right? So, you're not, but this is definitely one option that you have available. And one of the things you can do with our platform, right, is you can actually search for, okay, let's say, I think I use $300,000 to invest, right? You want to put $100,000 in a 3-year annuity, fixed annuity, $100,000 in a 4-year fixed annuity, $100,000 in a 5-year fixed annuity. Well, one of the things you could do by using a ladder is you could actually use our platform and say, okay, this product has the very best rates for the 3-year product. Let's put $100,000 there. And then this product has the best rates for the 4-year product. And then take another $100,000 and then put it into the 5-year product. So basically, you're able to split up your contributions into a few different companies in order to maximize the rates for the terms, if that makes sense. And like I mentioned earlier, you can also integrate CDs, bank CDs into this, right? So you could actually say, okay, well, I'll buy, especially if CD rates now are not as competitive, but they have been similar to fixed annuities before. So that's another option, is to integrate the CD in with the fixed annuity into your ladder, right? Again, I mentioned, when the products mature, you can request a check from the company, you can renew with that company, or you can transfer the funds to another company with a better rate, right? So you have different options you can take advantage of. Don't like the ladder idea, you can always just invite one, right? So you could say, okay, well, I want to put, and this is just one example of having a 3 and 4 and 5 year ladder, right? But you could say, okay, well, I'll buy a 4 and a 5 year ladder, right? So you can take a look and see. You can also take a look at the term and find out where the best rates are coming in, at where what maturities actually have the best rates, right? As well. But this is just another idea. You can either pick one company and go with that, or you can kind of diversify a little bit and actually create a ladder. In general, one of the things I wanted to mention was that, fixed annuities, I mentioned before, they pay the lowest commissions to companies. I've personally had some of the insurance agencies that we've worked with. I had a guy tell me it wasn't worth doing the paperwork on a fixed annuity. And these are all people that are independent, and they actually get all the commission, right? One of the problems you have, I'll talk on this later, but if you go to like a bank, right, the people that work in the bank might only be getting 15 or 20% of the total commission, right? So one of the challenges is that they have is that, they're almost forced into selling the high commission products just because their split of the commission is very low, and just in general. But yeah, just know that a lot of times with these products, there's not a lot of incentive. If you go talk to insurance agents, you're very likely to have them try to convince you to look at other products. This is why. It's money, right? It's really that simple. Some of them will, I mean, obviously there's still a lot of money flowing into these fixed annuities per quarter, right? So I don't want to, it's not like everyone's going to avoid selling you these products, but you definitely want to be aware that there's many people within the industry. In fact, it's common, I believe, that they might try to talk you out of them because to get a better return, right? So, or possibly get a better return, but also know that the products aren't typically guaranteed, right? So that's the other part of it. Another reason insurance agents don't focus on this is they're very likely to lose money marketing, right? If you take a look at what it costs companies to actually produce a client, right? A lot of insurance agents will do seminars where they go offer a free dinner. They do all this fancy. They spend a lot of money. They might spend $6,000 to $10,000 of their own money putting on these events, right? Well, they want to get their $10,000 back that they just spent. So they end up, they couldn't probably do a seminar and sell these fixed annuities and make any money. They would probably lose money or maybe break even, a lot of times. So, there's a big emphasis on selling the other products. So these are some things I think you should know, right? Also, I mentioned earlier companies that are sold through, if you go through banks and sometimes brokerages, they're only getting a piece of the commission, right? So, a large brokerage firm, when I worked at Edward Jones, I think we were getting, 20, 30%. I forget what percentage it was, but, they're only getting a percentage of that anyway, right? So these are some of the reasons why sometimes I know there's many consumers out there that are frustrated because you might want to buy one of these products, but the companies might not want to sell them to you, and they might want to put you through, that's one of the reasons why I started this platform to sell one of the main reasons I decided to, instead of actually just putting consumers in touch with agents on these products going forward, we wanted to sell them internally mainly because we knew we'll process the applications for you, right? I figured that if we connected, consumers with insurance agents, a lot of times they're going to try to sell the other products. So there's a reason why we set everything up this way. Anyway, now why don't we talk about, what is the difference between fixed annuities and bank CDs? Now, I created a column just to share some information on what is the difference between, a fixed annuity, or at least the MIGA, is really the insurance industry's version of a bank CD. It's the annuity industry's version of bank CD is what they are. Fixed annuity, if you just go down, it's offered by an insurance company. The terms are 2 to 10 years. The investment amounts normally are $2,500 to $1 million. The rates are typically higher than CDs for the same terms. There could be some liquidity, right? Some of the fixed annuities do have annual withdrawal options available for you to take out some of your money per year. taxes, the interest grows tax deferred. The insurance companies' annuities are primarily backed up by the insurance company, and they generally avoid probate. As long as you list the beneficiary, they're going to avoid probate, and the money will go directly to the beneficiary. I will make a note and say that you do need to keep your beneficiaries up to date with annuities. So, for example, if you are married and you get divorced and you leave your ex-wife on the beneficiary designation on the annuity, she will get the money if something happens to you. So if she's the beneficiary, then you need to update your contracts, and make sure that your beneficiaries are, or if you listed your girlfriend as your primary beneficiary, for example, and you didn't want to leave her the money anymore, you need to update the beneficiaries and keep them active, right? So that's fixed annuities. Now, bank CDs, just take a look and see how bank CDs compare to fixed annuities. The terms, most of the bank CDs are 3 months to 10 years. Annuities are typically a little bit longer on the short end, so 2 to 10 years. Bank CDs have a little bit more flexibility, especially on the lower end for lower investment amounts, right? They're easier to set up with, $500, $1,000, that type of thing. The rates on CDs are typically lower than fixed annuities. They're not as liquid, so generally you don't have any access without a penalty for bank CDs. So there's a liquid there. You will generally have a penalty to get to the money. Now, there are some bank CDs that have penalty-free access, but those typically have a much lower interest rate, lower rate to them. Taxes with a bank CD, you're paying taxes on the interest that's earned every year. There's penalties for withdrawals if you're getting to the money. They are FDIC insured, so it's FDIC insurance is really insurance. It's the Federal Deposit Insurance Commission, so it's the FDIC. And then probate might be required depending on how the CD is actually set up. Now, I wanted to spend a few minutes to just talk about what are the pros and cons of dealing with different, there's many different places you can buy annuities today in the industry. I'll give you at least my opinion on the different options that you have, the different channels within the industry. And then also talk about how that compares to us and what we do internally with fixed annuities. So when you take a look at banks, a lot of times banks have, I had someone tell me recently they have 5 to 8 typically annuities on their platform. We have over 40 to give you an idea. So, that's, you don't have as many products to choose from generally. Someone at a bank can only sell you the products that they have that are on that bank's approved list of vendors, of companies. Another thing with the bank channel is there's a lot of staff turnover. Typically, a lot of times banks don't have people that work there on the investment side for 15 or 20 years. It's not as common, right? Typically they might be there. Like I worked at 2 banks. I was there for a year or 2 and then left, right? So there are different reasons for that. I won't go into this video, but this turnover is a little bit higher, right? Also, there's mergers and changes and acquisitions. Anytime if the bank's parent company, that's one of the reasons I left. Actually, the first bank was that they merged and changed the complete program, right? And I didn't like it. I just said, you know what, I think our comp rate went down like 40%. It was a pretty significant change. I said, you know what, I want to go back to grad school, and that I went to work at Fidelity then. So just know that mergers and acquisitions, that's another potential that can affect the staff there. And also, if you just take a look at how much experience the people have there that are selling annuities. Banks have been known to take, someone might work at a bank as a teller, then their personal banker, then they take their insurance exam, which is not even that difficult. And then all of a sudden they can sell annuities, and they don't know very much about the industry. They haven't been in the industry that long. So in my opinion, they're not as experienced and they're not as educated in general as what you'll find at some of these other channels. Now you could take a look at what I call captive insurance agents. Now, a captive insurance agent is an insurance agent that works for an insurance company that really only sells their company's product. So if they give you their business card and the name of the company is on their business card and they're representative of that one company, typically they're only selling that product. And or they might tell you they're independent, but what they don't tell you is they're they're compensated much more to sell their product than they are other companies' products. So this is something at least to be aware of, like how many options do you have, right? Agent turnover, with all these options, really there's going to be more agent turnover. And also with this captive agent, I've noticed that a lot of these captive agencies, captive insurance agents, captive insurance companies are much more likely to sell these old school fixed annuities, which I don't like those, right? Because you're subject to whatever the insurance company wants to pay. Not MIGAs, where the rate is guaranteed for many years, but it's the old traditional fixed annuities the industry stopped really selling, right? So, and also has a sales-based approach for the most part. So that's captive. Now, brokerage firms, large brokerage firms. Let's talk about those. They're brokerage firms in general are really focused on selling brokerage products in general, right? And they also might sell variable annuities. Which could be a good thing, right? I mean, it could be a good thing that they actually have access and they could sell variable annuities. But typically, so it's kind of a good and a bad thing. Sometimes they do have access to more different types of products, but also they have a lot of other types of products to actually sell you. So if you say, you know what, I just want something simple. I don't want to be sold a bunch of other stuff. I like simplicity. I want a guaranteed return. You're going to find that. And when you work with brokerage outfits, just know that a lot of times, they don't have nearly as many products as we do to offer, but also they're going to try to cross-sell you variable annuities, fee-based accounts. Again, there's nothing wrong with this. Just know that it's likely to happen, right? And also what's going to happen when your annuity matures, right? They're going to try to convince you to go buy something else, right? So the fourth option is independent insurance agents. Now, in my experience, most of the independent insurance agents we're going to focus on selling index annuities, right? They might sell 2 to 6 companies. There's a really well-known, in Georgia, there's a really well-known insurance agency that does business in most of the U.S. I don't know if they're 50 state licensed, but they do business in most of the country. Supposedly, they sell one index annuity product to everybody, right? This was a rumor that I heard from a conversation with someone within the industry. Right, so independent insurance agents are really going to focus on selling index annuities. There's a reason why we put, if you're interested in index annuities, we can actually connect you with an insurance agency, usually in your state or in your area, that actually will put together a proposal on the best index annuities in the market. There's nothing wrong with the products; they're just very different than the fixed annuities that we offer. A lot of times these agents will focus and try to specialize on, I would say, 2 to 6 companies. The products, have a lot of more moving parts and bells and whistles. So, typically they'll focus and try on a few products and then sell those. So they're focusing on index annuities for the most part. Now, what do we do differently? Well, internally here at Annuity Resources, we specialize in really selling fixed annuities. We can also do income annuities, so SPIAs and DIAs, but most of our business is in MIGAs, the fixed annuities that we actually have, right? We have a salary-based staff. The reason that I wanted to pay everyone a salary that works for us is I don't want you to feel pressured to buy something from someone. And I know that if you pay someone straight commission, they're going to pressure you a whole lot more than if you pay them a salary. So salary-based staff, we specialize in fixed annuities. At the time this is being recorded, we actually have 41, I think, companies on our platform. But we're still working on this. We're trying to get up to 50. I mean, I want to have a super center. I want to have the largest fixed annuity platform in the United States because I believe this is what's good for you. It's not good for us. It's good actually for you. We also have a consumer-based digital approach where you can apply online. You can go through and get educated online. No one's going to come to your house. No one's going to try to meet with you in person. Right? It's just we have a different way of doing things, but some of you, I'm sure, will appreciate it and like it, right? So this. So anyway, I wanted to go through and kind of share at least, if you're still listening, the information in the last few minutes I think will help you. You can actually take, you can reference this grid and say, okay, well, this person's talking to me. Which channel do they fit in the industry, right? And this will kind of help you make a better decision, I think. There's a quote. Mr. Leroy Lincoln said he was the president of the world's biggest life insurance company, Metropolitan Life in New York, stated, "You're as safe and as well protected, and the cost is just as cheap if you buy from a small insurance company as from the largest." Now, I want to talk about the legal reserve system for a few minutes and just how they protect annuity policyholders. Now, if you go to your bank and you give them $1, typically what they'll do, how the banking system works, is they're going to take that dollar and they're going to turn that into loans. They might turn $1 into $10 in loans, right? What insurance companies do is they take your dollar and they must keep around $1 in assets that are separate from on the books, right? So the legal reserve system helps shield kind of the assets from the company from their customer assets, but also they have to basically keep the threshold or the ability for them to take risk, and the leverage in the system is not as high with insurance companies as it is with banks. Because what happens when banks fail, a lot of times, it's those loans going bad. So instead of $1, if they have, let's say, $100 million in deposits, and they make, $1 billion in loans, well, what happens if that $1 billion of loans, they lose 10 to 20% of that, right? Then they're wiped out, right? So $100 million leveraged up 10 times to $1 billion in loans, right? If just 10% of those loans go bad, then their whole deposit base is wiped out. So anyway, just know that this is one reason why the FDIC protection is very, very important for banks, because you need to know that your money is actually safe and protected. You don't know what's going to happen with the bank. Insurance companies in general, have to they're not leveraging the money nearly as much, and therefore, they're typically safe. The legal reserve system, this was designed to protect policy owners and to protect the insurance system, by the way, too. The entire insurance industry is built based on trust. We just had a claim. There was a big ice storm in Texas recently, and we just had a claim on my home. We had a water leak we had a RO system in our kitchen, this reverse osmosis system, and there was a water leak that got underneath the floor. Right, ended up damaging the wood floors. And anyway, it was kind of a mess. And, our premiums per year, right, we wouldn't, if I doubted that we were going to have the protection, I wouldn't be paying the premiums per year. People wouldn't, if it was questionable whether an insurance company would pay, if you pay, let's say you have term insurance, if there was any doubt on whether the insurance company would pay at your death, why would you make premium payments for 10 or 20 years? You wouldn't, right? So the entire insurance industry is really built on trust. So this system was designed really to protect, consumers, really, for the most part, right? Because, really designed for protection. During the Great Depression from 1929 to 1938, over 9,000 banks failed in the United States. And this was the worst economic time of in our history, right? If you take a look at life insurance companies during that time, there were, from what I was reading, around 20 of 250 life insurance companies went into receivership. And a lot of times what happens when life insurance companies go into receivership, typically what happens is there's a lot of effort made to try to, other insurance companies try to, basically purchase and acquire the existing book of business and then merge them into their book of business, right? So anyway, I had a coworker that used to keep a penny on her desk at one of the banks I used to work at, and she used to say, well, this penny is more than what most people have lost in a fixed annuity. I wouldn't go as far as to say that, but just know that a lot of times the system was designed for protection, right? Another thing, if you wanted to be conservative, right, another note from the Depression that I think is relevant is that the insurance companies that had property and casualty divisions fared much worse in the 1930s than the insurance companies that didn't, right? So how that comes to annuities is that's just a little tidbit of information. Typically, the insurance companies that were really big into auto and homeowners insurance during the Depression did not do as well as those that didn't. So that's just another tidbit of information for you. Another thing, in terms of protecting the system and safety, there's a lot of reinsurance and mergers and acquisitions used. Right, I talked about mergers and acquisitions, insurance companies basically being combined with others. That's something that they try to do at a state level, is try to combine, companies with others to protect the system again. And also reinsurance, right? So companies will use other forms of insurance with other companies to help protect, right? Now, in terms of finding the best rates, this is just this is a little snapshot of our website, right? And the filter. You notice the filter there. Currently, when I did this today, there were 240 different products on our platform, but you can actually use this filter and actually sort by the state, by the rate, by the rating, by the term, the investment amount, and also by the insurance carrier itself. And you can also, if you choose this rate changing soon, you could actually see when rates are changing in the future. So we've really designed a lot of information. Once you click on the companies within our platform, you're going to see all the product information. So you're in complete control of our process. We'll show you the rates, the products, and information on our platform, and you're in control to filter the database. Another thing I'll mention was that we have an easy online application process. We actually it takes 10 minutes, maybe a little bit longer than 10 minutes, but we tried to organize this to be very simple and easy to use. I've actually done this on my mobile phone, on tablets, to where it's very easy to use. The reason we need to know, and if you're anything like me, I would much rather go through and answer these questions through a digital application than I would to have an insurance agent ask me all these questions, right? So it does take about 10 minutes. It's this is part of for compliance, it is important. All the insurance, this information is actually used when we actually prepare your application for the different products. But just know there's an easy digital process if you do find a product that you're actually interested in. And if you're interested in the highest guaranteed returns, again, you can go to annuityresources.com and actually check out what we do. Thank you.